Today on Retiring Well with Centennial Wealth Advisory, we are talking about the often misunderstood and misapplied concept of portfolio diversification to minimize risk exposure.
Have we forgotten from our past lessons? Have we learned from our mistakes? Or is the past repeating itself? Are we once again thinking we're diversified when we're not?
Coming up, we'll discuss real-world examples of investors who thought they were diversified, but in fact opened themselves up to the risk of the stock market. What does it mean to be diversified, and how can you be sure your portfolio is diversified?
Now I ask you, what do you think? Somebody's got 23,000 positions. Are they diversified, yes or no? Well, most of us would immediately answer, well, of course they're diversified. Yeah, sure. That's where we make our mistake.
All this and more on Retiring Well with Centennial Wealth Advisory, starting right now.
Retiring Well with Centennial Wealth Advisory, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Centennial Wealth Advisory, where we believe your best is yet to come.
Welcome to Retiring Well. I'm your host, Michael Reese, and I'm really excited. We've got a great show lined up for you this week. We're talking about diversification. Why do you really need to be diversified? What does it mean to be effectively diversified? A lot of us, a lot of you, think you're diversified, but at the end of the day, when you actually do the math, you may not be as diversified as you think you are. Well, why not? That's what we're going to talk about today. This is going to be a real important episode. Now, before we jump in, just real quickly, I want to share with you why we do this show. You see, most of the financial media, what do they talk about? They talk about how to grow your money, how to make it bigger. What stock should you buy? Interestingly, they almost never talk about what stock you should sell. But what stock should you buy? Where should you put your money today? And all these fun things. But none of them, or very, very few of them, actually talk about what do you do once you've built up your portfolio, where now you just want to protect what you've built. You want to make it last through your second half of your life. That's what this show's all about. So let's go ahead and jump into today's topic, which is diversification. And why is it important? What is it? And how do you do it effectively? So I have here the definition. I went on to Investopedia.com and I looked up the definition of diversification. Here's what it says. Diversification is a risk management technique that mixes a wide variety of investments within a portfolio. The rationale behind this technique contends that a portfolio of different kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. So, what the heck are they really saying there? You know what they're saying? Don't put all your eggs in one basket. The same thing your grandmother taught you. Just don't put all your eggs in one basket. Use different baskets. That's all it means. And if you use different baskets, over time, you should do a little bit better. There you go. That's the English version of the definition. Now, why is this so important though? Why do you have to even worry about this? Well, I have a couple stories here. And the first one comes from CNN Money. And the date of this article right here is, listen to this date, November 26, 2001. I'm selecting this article for a reason, because what we're going to learn is that all of us, we don't learn from history. We just forget recent history too quickly. So here's what happens. Houston, this from Reuters, after climbing utility poles in all kinds of weather for 35 years, Roy Renard was hoping to retire soon. But that, of course, was before the collapse of Enron. This guy worked for Enron. He had all of his money in Enron stock. In this article, it gives his story about how he talked to financial advisors. They all told him, hey, don't put all of your eggs in the Enron basket. But did he listen? No, because Enron was a great company. Every analyst said how wonderful a company it was. Everybody agreed Enron was an awesome company with a brilliant future. And he worked there, so he figured, oh, I know what's going on because this is where I work. It wasn't just Roy who climbed utility poles, it was executives, secretaries, the middle management. A lot of people at Enron were doing this. And what happened? Enron stock collapsed. Everybody lost all their money. They were all starting over. So you would think, oh, that happened to Enron and WorldCom and all these .com companies. You would think, oh, we would learn from our mistakes. Oh, wait a minute. Here's another article dated April 17, 2009. Retirement dreams disappear with 401k plans. Do I really need to read this article? You know what happened in 08. A lot of us, lost a bunch of money. Why? We thought we were diversified. We thought we learned from our mistakes of the early 2000s, but did we? Nope, we didn't. We didn't learn. Well, here we are today. It's 2016. 7 years have gone by since this one came out. So we had 2001, 2009. Here it is 7 years later. Have we forgotten from our past lessons? Have we learned from our mistakes? Or is the past repeating itself? Are we once again thinking we're diversified when we're not? Don't go anywhere, because coming up I'm going to share a real life example of where a lot of people are.
Have you called us yet to meet with our team? Let us help you with your retirement planning. Today is a great day to take the first step. Call us now at 512-265-5000.
Essential financial strategies for a comfortable retirement. Join the Centennial Wealth Advisory team for an informative and exciting presentation with complimentary gourmet dinner and learn how to protect your assets from market volatility, how to find growth and security in today's volatile market, how to prevent outliving your money, how decisions in Washington, D.C. are affecting your retirement, how to safeguard your assets from unnecessary taxation, the 4 ways to make sure your advisor is giving you expert advice, and much more. Choose the date and location that works best for you. Tuesday, May 24th or Thursday, May 26th at Gumbo's North in Georgetown. Tuesday, May 31st or Thursday, June 2nd at Cafe Blue in the Hill Country Galleria. Tuesday, June 14th or Thursday, June 16th at Trulux in the Arboretum. Presentations start at 6:30 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 512-265-5000 or visit sen-wealth.com/events to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 512-265-5000 today.
Welcome back. This week we're talking about diversification and why it's so important. We've looked at history. We see that over and over again, and by the way, I can go back in history and find even more examples, but we see over and over again, we keep making the same mistakes. We keep thinking we're diversified and we're not. And then the market goes south and bang, we get penalized. We just get punished for it. Well, here we are today, 2016. It's 7 years since the market has been down. We are 7 years into a bull market. At some point, it's going to go the other way. Markets don't go up forever. The longer they go up, the harder they fall. How hard is the next fall going to be? I don't know. But I do know this. A lot of you think you're diversified, and you're really not. And I've got a great example here, because in my hands here I have a Morningstar report. Now, this is something that we run. This particular person, he and his wife, they watch this show just like you're watching us now, and they called us and they said, hey, I want you guys to analyze where we're at. We think we're okay, but we just want to have a second opinion. We just want to double check things. And so they came in and they brought their portfolio and we run an analysis. And we use Morningstar, so we run a report. It looks like this. And there's a couple things I want to bring to your attention here. Because a lot of you watching the show, if you're sitting there right now watching the show, odds are actually pretty good that you might be like this guy. So here we go. This guy, and obviously I can't share names because of privacy, but this family, this couple, they had managed to save $2.5 million in their portfolio. So, I mean, isn't that fantastic? That's a lot of money. They saved a lot of money. They did a great job building up their nest egg. And, you know, they were proud of it, and they should have been. Now, you might have more, you might have less. The amount doesn't matter. Listen to what's going on here, though. This guy had an advisor who was charging him 1% a year. Now, by the way, if you do the math, 2.5 million, 1% per year, his advisor was charging him $25,000 a year. And if you look at the portfolio, and I've got 2 pages here, like 2 pages of mutual funds that this guy had. Now, this manager was managing these mutual funds, picking and choosing amongst funds. And I asked, well, how often does he change those funds? Well, not too often. Now, interestingly enough, when we did the analysis for this gentleman, we found that on the fees, those mutual funds, they were charging another 1% on top of the 1% he was paying his advisor. So we shared with him, hey, heads up, you're paying your advisor $25,000. Guess what? Your mutual funds, they're costing you another $25,000. So you're paying $50,000 a year for this portfolio. You can imagine he wasn't exactly thrilled about that. But then when we looked at his analysis in those mutual funds, we saw, oh, look here. He has 11,347 stocks in those mutual funds. He has 11,724 bonds. In other words, this guy in this mutual fund mix, they had over 23,000 positions. 23,000 positions. Now I ask you, what do you think? Somebody's got 23,000 positions. Are they diversified, yes or no? Well, most of us would immediately answer, well, of course they're diversified. Yeah, sure. That's where we make our mistake. Because in this graph right here, this blue graph, and on the TV, we'll zoom in on that. On the blue graph, that blue graph represents the stock market, the S&P 500. The red line, that represents his portfolio. What do you notice about the red line in the stock market? The answer, it's basically the exact same thing. This guy had 23,000 positions, stocks and bonds, and at the end of the day, he holds the stock market, the S&P 500. Now, what does that mean? Over the last 10 years, he's averaged, after his advisory fees, he's averaged 6.88, 7%. After his fees, he's averaged 6. His exposure in 2008, this portfolio lost 33%. So is he diversified? Thought he was. But in the real life, was he? Not at all. Don't go anywhere. After the break, I'm going to share with you why.
Have you called us yet to meet with our team? Let us help you with your retirement planning. Today is a great day to take the first step. Call us now at 512-265-5000.
Let's talk about the diversity of your retirement portfolio.
Nowadays, you always hear you need to be diversified. But what does it mean to be diversified in a portfolio? It means to hold assets that aren't correlated to one another. This allows you to narrow your range of returns while not decreasing your average return. This is paramount in retirement, especially when you're taking income. Holding 200 different stocks does not mean you're diversified, and holding 30 different mutual funds does not mean you're diversified. To find out how diversified your portfolio is, give us a call at 512-265-5000 and talk to one of our advisors about a free, no obligation portfolio analysis.
Do you have questions about the diversity of your retirement savings? We have answers. Give us a call right now at 512-265-5000 to talk to our retirement strategy team. Again, that's 512-265-5000. It's free to talk and we can help. 512-265-5000.
Essential financial strategies for a comfortable retirement. Join the Centennial Wealth Advisory team for an informative and exciting presentation with complimentary gourmet dinner and learn how to protect your assets from market volatility, how to find growth and security in today's volatile market, how to prevent outliving your money, how decisions in Washington, D.C. are affecting your retirement, how to safeguard your assets from unnecessary taxation, the 4 ways to make sure your advisor is giving you expert advice, and much more. Choose the date and location that works best for you. Tuesday, May 24th or Thursday, May 26th at Gumbo's North in Georgetown. Tuesday, May 31st or Thursday, June 2nd at Cafe Blue in the Hill Country Galleria. Tuesday, June 14th or Thursday, June 16th at Trulux in the Arboretum. Presentations start at 6:30 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 512-265-5000 or visit sen-wealth.com/events to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 512-265-5000 today.
This week we've been talking about diversification, and number 1, why do you want it? Number 2, are you really as diversified as you think you are? And we saw an example of someone who thought they were very diversified. In fact, given that they had over 23,000 positions, we all thought they were diversified. Yet at the end of the day, they weren't. Now, when it comes to measuring how diversified you are, remember, what's the purpose? The purpose is to make your returns more predictable, not so erratic, if you will. I have a great little visual that I like to use to identify kind of where you are versus where you maybe could be. Now, obviously, in order to make this visual work, you need to know where you are. You have to know where you are. And so if you haven't called the office to come in and get your retirement roadmap completed, you may not know where you are. But assuming you do, we can use this little a model, if you will. So what I have here, you may have, watching the show in the past, you may have seen me use the concept of a road, and I would draw the road horizontally, if you will. Well, lately I've taken to drawing the road more vertically. And the reason is that I think it does a better job helping you identify and visualize kind of where you are versus where you could be. Now, I share in advance what we're about to do is not drawn to scale because unless I had graph paper or something, we can't do that. But still, this will be a good indicator. So let's go ahead and put some numbers on. In the example that we talked about today, you might recall that the gentleman over the last 10 years had averaged about 7% per year. However, he was paying his advisor 1%. So 7 minus 1 means his average return was about 6%, right? Which isn't so terrible in the last 10 years. It's been kind of a blah 10 years. Well, it's just been a bit of a bull market minus one big drop in 08. But anyway, not the worst outcome, especially for a diversified mix. And then we saw, what was his best year? Now, I don't know if you remember this, but here it was. Way over here, he was plus 45%. That was his best year. And, I think all of us would be happy with a plus 45, wouldn't we? On the other hand, though, what was his worst year? The worst year was minus 33. So what we have here is, think about it like you're trying to hit a target. And this target is bouncing back and forth amongst the edges. So you're trying to hit 6%, but you got this really wide, it's going all back and forth super fast. How easy is it going to be to hit that target? It's going to be pretty hard. And you can imagine that path, that's like a roller coaster that you're going on, which is not what we're trying to accomplish. That's not what diversification is. It's what he had. He thought he was diversified. turned out that he wasn't even close. Now let's compare that to something that might be more possible, something that we do in our office all the time. So in our office, if we're targeting a 6% return, if you are effectively diversifying your portfolio, you should see something more like this. Maybe a line here and a line here. And you might see that for us, the best return you get might only be 17%. In other words, it's a heck of a lot closer than 45. So in a good year, you don't make as much money. But guess what? In a bad year, you don't. Yeah, you're already completing it, right? You don't lose as much money. In fact, for us, it might only be a -5. So when it comes to building a portfolio that's truly diversified, that's effectively diversified, that's accomplishing what you want, trying to be a lot tighter, you just have to make sure you're putting together portfolios that actually have those kinds of outcomes. And here's the challenge. In the real world, when you're dealing with most of these big brokerage houses or you're dealing on your own, what are you using? Stocks, bonds, mutual funds. And when you use that mix, you often get this very wide variation. If you can look outside the box a little bit, you can make it a lot tighter, and that is your goal.
Have you called us yet to meet with our team? Let us help you with your retirement planning. Today is a great day to take the first step. Call us now at 512-265-5000.
Let's talk about retirement income in today's economy.
Are you using your savings for retirement income? Are you worried about outliving your money? If so, you're not alone. In fact, that's retirees' #1 concern, even more so than dying. And unfortunately, in 2008, we know that if another market crash happens, a lot of folks' concerns out there will become a reality. Here at Centennial Wealth, we specialize in retirement income planning. So if you would like us to give you a portfolio analysis to see how your plan stacks up when the next market correction happens, give us a call at 512-265-5000.
Do you have questions about your retirement income planning? We have answers. Give us a call right now at 512-265-5000 to talk to our retirement strategy team. Again, that's 512-265-5000. It's free to talk and we can help. 512-265-5000.
All right, here we are again with my puppy Banks, and you can see her. She's getting bigger, isn't she? When you last saw her, she was 8 weeks old, just a tiny little puppy. I mean, I think she was only 10 or 15 pounds or something back then. Now, look at her. She's, I don't know, 30, 35 pounds, and now she's 14 weeks old, and they say she'll end up being 80, 90 pounds by the time she's all done. In any event, when we were last together with Banks, she was busy picking a stock. Now, if you'll recall, my little girl here, she has spent her entire life to that point trying to figure out what stock she should pick to bring you, our viewers, a hot stock tip, right? That was her entire goal. That's all she wanted to do, is bring you a hot stock tip. And, well, you can tell she's not very excited today, because today I'm going to share with you the results of her hot stock tip. Because remember, what did she do? She went out, she picked Nike stock. The idea was that we would compare the performance of that Nike stock to none other than the Oracle of Omaha himself, Mr. Warren Buffett. And so why don't we go ahead and bring up the results so far so that you can see how my baby Banks here is doing against Warren Buffett. And as you can see from the screen, Warren's up 6.2%, and oh no, poor Banks is losing money. Yeah, look at her. That's why she's so sad. She's lost money for you, our viewers. If you had invested in Nike stock thanks to Banks' recommendation, you would have been down a little bit as we're sitting here today, and well, that makes her sad. And all I could think of is, what the heck went wrong here? I mean, what went wrong? My baby spent her whole life really doing the research to figure out what would be a really good good stock tip for you. And she spent her whole life picking Nike stock, and she even had a plan. You remember the plan? The plan was she was going to chew up Nike shoes so that people would have to buy new shoes, which would increase sales for Nike. That would increase profits, and their stock price would go up. So she had her diabolical plan all set, and it didn't work. And she doesn't know what's going on. I mean, the poor thing, 14 weeks, and look how sad. She doesn't know what's going on. She's confused. So I thought, it's my job as her dad to, help her out, do some research, figure out what happened to my poor puppy's stock tip. And, well, I've got some news here. I think I've figured out what's going on with my poor baby. You see, I went around our house and I started looking at the shoes that Banks was chewing on. And remember, she's supposed to chew on the Nike shoes. But, well, if I pull out one of the shoes here in the house, I don't know if you guys can get a close-up on this or not, but this shoe, this is one of my son's shoes. Notice that the swoosh is not on this shoe. This is actually some shoe from, I think the company's called Vans or something. My poor baby Banks, she's chewing on the wrong shoes. She's not chewing on Nike shoes. She's chewing on Vans. Uh-oh, see? See? She's chewing on the wrong shoes. So poor Banks, no wonder her stock pick is not doing well. She's not old enough to figure out which shoe is the right shoe to chew on. I mean, look at her. I'll give that to you, baby. She's pretty much destroyed that one, as you can tell. But anyway, maybe, again, she just doesn't know. It's supposed to be Nike shoes. And, oh man, the poor thing. But hey, she's just a puppy, right? She's only 14 weeks old. So here's what I'll do for you. I'm the dad. It's my job to teach her. So what I'll do, maybe the next time you see her, maybe by then I will have taught her to chew on the proper Nike shoes. And that way, if she is, maybe that way people will buy more Nike shoes and the sales will go up and the stock price will go up and maybe her stock pick will do better. Well, I'll tell you what, I'll leave you here for now. We'll continue following Nike stock, see how it does, and we'll keep you posted on my puppy Banks.